All right, today I want to try to show you something about the complication and complexity of the world and maybe some ways of understanding when models are wrong. So the model I'm going to talk about today is called efficient market hypothesis. And this is one of the greatest mistakes and most obvious mistakes out there today. So let's jump in. So what is efficient market hypothesis? Uh, it's a financial theory about asset prices, right? And how they fully reflect all the available information at the time. So the asset prices reflect information. And in theory, that would make it impossible to beat the market. Okay. The stock market in particular is what they're talking about here, although it really applies for any market to achieve, say, above average returns. So that formulation is already wrong because obviously if you have average returns, you have above average. Like averages are made up of different numbers. So it doesn't really make any sense to talk about that. But the point of beat the market is correct. If efficient market theory is true, then you can't consistently beat the market. That would be impossible. And a lot of people try to sort of redeem this theory because it's observably false, right? There are people who consistently beat the market all the time. And there are reasons why it doesn't seem that way. But there's three forms. There's weak, semi-strong, and strong, right? And they differ in the type of information that they're assuming are in the price of the asset, in the pricing. So it sort of depends, do you think index investing is better than stock picking or whatever, right? And there's all of these rationalities because none of this stuff maps. It just doesn't map. And that's sort of the problem, is things not mapping. And there's also different schools of thought around this, right? So behavioral economists think that the imperfections in the market are just cognitive biases. Some people are overreact to things. Some people misrepresent things. Some people are overconfident about things. Some people have imperfect information and therefore it's not the market's fault. That might be a hint. And then people make mistakes. So there you go, right? But let's sort of think about this. So what things would have to be true in order for efficient market hypothesis to be true? Well, the price would have to reflect information. That's the core of the theory, is that the prices are reflecting the information. So the problem with this is on observation. So I'm just going to talk about observation. I'm going to do logic as well, but we'll talk about observation. Prices are moving way faster than information is changing, especially in the stock market. Like, you don't have the earnings report for Microsoft. You don't have up to the minute sales numbers, and they wouldn't be relevant, but there's no information that correlates to the price of a stock. That's why stocks trade at like 4 times earnings. What is that? And they don't all trade at 4 times earnings. So what is, like, efficient market hypothesis can't be right. Right there. Boom, done. But I'm not going to stop there. I'm going to show you all the ways that I can come up with, and maybe they're not all the ways, because I'm not going to pretend that I can know all of them, because it's just so wrong on so many levels. One of the major problems is that in order for efficient market hypothesis to be true, all of the participants in any given market or in any given stock, for example, would have to be there for the same reasons. But the fact of the matter is, some people use the stock market as a way to store their cash without having cash, whether it earns money or not, right? Because the odds that inflation will eat your cash versus the stock price are not dissimilar enough. In fact, predicting inflation is much harder than predicting a stock price in general, because a war could break out at any time and inflation could go nuts. So, there's a risk play here. And Nassim Taleb, you should read all his books, he talks about risk. So there's a risk play already in having in the market. Some people use cash to prop up the value of the stock. That's what things like stock buybacks are for. Okay, well, if stock buybacks exist, how could the market be efficient? It couldn't be. That would already destroy the hypothesis. Again, all by itself, one simple fact, right? We're using science correctly. One fact destroys the hypothesis. All done. We don't need it anymore. But again, I'm not going to stop at one or two here. I'm going to show you a bunch so that you can get a sense for how to think these things through. And look, you shouldn't do what I'm doing, right? What I did was sit down and actually think about, well, let me count the ways. No, no, no. You have one thing that destroys the thesis. Move on with your life, because there's other things you can put your time, energy, and attention towards. This is just more of an exercise for me and an exercise to show you something. It's not something you should do because it's silly. Efficient market hypothesis is so wrong in so many ways, and it's so easy to figure this out that I'm surprised that anybody even talks about it anymore. And it's not like I'm the first person to note this. Right? This is back and forth forever. This is worth thinking about why it's lasted this long. So the other problem is people trade at different time frames. Some people use stocks in the stock market for short-term gains. But if you know anything about things like mutual funds and stuff, they only trade once a quarter, guys. Once a quarter. That's it. They don't trade the other days in the quarter. Well, obviously that information isn't reflected in real time. Like what they're going to do with their stock basket holdings when it comes time to move them around or reallocate them, because two companies could own the same stock and have very different ideas. Because in one company has a basket with a much better returning stock and the other one has a basket with much worse returning stock. So one could sell while one buys at the same time. How is the price reflecting information? I don't understand. I mean, sure, it's reflecting some kind of information, but you don't have access to where that information comes from or why it's relevant. So the buy-sell reflecting information doesn't work. Also, if you're in it for a 5-year time frame because you need to stash money away for 5 years, again, because you're hedging against inflation, and look, you can watch CNBC. They'll talk about, having your money in the market instead of having it, quote, in cash. Well, in cash is an inflation risk, and in the market is a stock risk. But stock market's already leveraged 4 times earnings, 3 times earnings, 25 times earnings, whatever it is. It's already leveraged. So, bets are bigger there, right? Wins and losses are bigger in the stock market. So some people are day trading. They're not going to stay in the market. They're just there for a quick hit, right? And they generally tend to make less money or get wiped out more easily because they're using leverage or some other stupid thing. And so obviously, what information is being conveyed by someone day trading versus somebody who's got their money there for 5 years? I don't know, man. I mean, there's some information there for sure, but who cares? From your perspective, you don't have access to enough of it to make a difference in predicting or understanding after the fact. In hindsight, the stock changes. You can just look at them and say, oh, the stock changed. That's all you can do. And the thing is, there's reasons why people hold stocks in spite of a change of information. So one reason might be that they don't want the stock to go down because they're looking for a certain return. So some people trade on time frame and some people trade on return. We can argue trading on return is stupid because the time value of money or whatever, which is valid by the way, but some people trade that way. I don't know what to tell you. Right? They might be perfectly happy to take a risk or have a risk. A lot of these traders have risk calculators that say, all right, I hope for another 6 days, what's the odds that I'll get a slightly better number? So the fact that there's a change of information doesn't mean that someone's going to sell, even if it should theoretically trigger an event in them. And you don't have access to their motivations and their reasonings. And look, some people sell stocks at a loss to take a tax cut so that they can get a tax cut offset for their larger gains in some other stock. How are you going to track this? Why is this information that's being tracked in the price? I mean, yes, this information being tracked in the price is totally impractical. Who cares? You have no access to it. It doesn't tell you anything about the price in advance, and it doesn't tell you anything in hindsight either. You can't derive that the person took a loss on this particular stock because he had a gain on this other stock because of the price of both of those stocks. Because you'd still have to know he owned them and in what quantity and what price he bought them at. And that's the other problem. People bought stocks at different prices. So the stock may go up to 100 and down to 90, and somebody who got it at 10 would still sell because, who cares? Or maybe the fact that it went down told them, oh, it's never going to reach 100 again. I better sell it at 90 now because it's not going back up there. How do you know that from the market? You don't know what they're thinking from the market. And they may be right about that. In fact, most professional traders are right about that, which is why they're raking it in while you're losing money. So there's lots of reasons why people do what they do, and the market doesn't reflect those reasons. It just reflects the result of those reasons, but you don't know what those reasons are. And the thing is, another obvious hit for efficient market hypothesis, not everybody looks at the same info at the same time. Some people check their stocks once a month. Some people check them every day. Some people check them once a week. Some people check them once a year. Some people check them once a quarter. I know all stripes of those people for real. So how could efficient market hypothesis be even giving you the aggregate of all the information of all the people in the market if they're not even looking at the information that's reflected in the price? Obviously impossible. So that's kind of a big deal. And then, of course, there's the interpretation of the information, which again, what price did you buy at? Because that determined your buy, sell, hold. Or what target did you have for the stock? Because that might determine when you buy when you didn't have any. So your interpretation of the information, it hit 100, went down to 90, but it's really worth 120. So I'm going to buy it at 90 because it'll never be at 90 again. It's only going to go up. So here we got one guy selling, one guy buying at the same price. What information is being reflected by that price? Nothing. Nothing. Zero. Sorry. It isn't there. Efficient market hypothesis is crazy. It's just nutty. It's a nutty idea. And the thing is, the information that's in a price is illusory. It tells you about the current value, but it doesn't tell you anything greater about the stock or about the player. All it really does is reflect the pressure to move the price at this particular moment. And that's all it really reflects, is how much pressure is there for the stock to move, up or down or sideways even, because that's a movement, right? There's three. There's always three. There's never two. Three. So it's good to know, because stocks can move in four ways. They can move up, down, sideways, or not at all. There can be no trading. I've actually owned stocks where there's no trading for like hours. It's just thinly traded stocks. It happens, particularly with dividend stocks, which makes a lot more sense. Right? Dividend stocks, like regular stocks and dividend stocks, would have a different way of understanding anyway, because everybody sells after the dividend is granted. You wouldn't sell 2 days before the dividend, right? So they have interim trading patterns that don't exist in stocks without dividends. It's all sorts of ways in which this is wrong. Now, there's still stocks, they're still traded on the greater market. What information does the market contain again? I'm a little confused. And well, you should be. And the thing is, the change in value doesn't, again, tell you what people are going to do. One person interprets change in value one way, another person interprets it another way. So thinking about the market is difficult unless you think about it as offering a service, because a market tracks service, not goods. Markets do not track goods. They track the movement of goods. So what you're looking at is the servicing of the goods, the movement, the buying and selling, the shorting and covering. That's movement. That's not the goods. That's just movement valuing the goods. And that's really what a market is. It's just a representative or an abstraction away from the goods. It's actually an abstraction away from the trading of the goods, because usually it's just paper, and which has since been, usurped by digits on a computer, right? It's all digital. So this binary information is now what you're looking at, and it's not really clear what should be going on. So the question is, why has this sort of myth persisted? Well, it's a nice flat way of viewing the world. As efficient market hypothesis, the price reflects all the information that's available in the market, which is impossible anyway. But even if it did, let's say the price is an aggregate of all the information available in the market. Who cares? Aggregated information, okay, and now what? Right? There's nothing you can do with it. But it at least gives you a sense for how the market works, kind of. And obviously they've split it into three parts because they figured out, any definition doesn't work. because it's so far off. But no one ever bothers to do the logical breakdown. No one ever bothers to do the observation and say, wait a minute, that can't be right because this one fact makes it wrong. Because sometimes one fact makes things wrong. This is the entirety of science is based on this concept. This is the proper use of science to disprove the hypothesis. That's what science is for. Science isn't supposed to prove anything. It's supposed to disprove all the bad things. So when you use science correctly, you kind of figure out, well, who came up with this nonsense? This is crazy talk. It's actual crazy talk. Now, there's a lot of things like this in the world. So you have to have, if you want to have a critical eye, you have to have it very critically. You have to use observation and logic separately, and you always anchor your logic in observation. You don't anchor your logic in efficient market hypothesis. So the way you come to the conclusion that there's 3 types of efficient market hypothesis is first you have to buy into the idea of efficient market hypothesis. The only way to do that is to never look at a market critically. Because the minute you look at a market critically, you realize the generic thesis of efficient market hypothesis is either completely wrong, is one way to interpret it, or correct but completely useless for any purpose whatsoever. So once you understand that, you don't waste your time trying to figure out how to fix it or redeem it or whatever. You go, oh, this is wrong. Let's understand the markets differently. Let's move on, right? Because otherwise you get stuck in this, well, let's find a logical, rational, reasonable way to make this theory work. No, the theory's wrong. Don't make it work. It's wrong. You can make any wrong thing work with logic. That's very easy to do. People have been doing that with efficient market theory for over 100 years now. But it's still wrong, and therefore their theories still never match up very closely at all, really, with reality. Now, that's not to say you can't derive useful principles from assuming something silly like efficient market hypothesis. But I dare say that there's much better ways to understand, say, the stock market than efficient market hypothesis. It just doesn't make any sense. It's observably completely silly and couldn't be of any use even to the extent that it's correct, right? So this flat view of information, oh, the information is buy, information is sell, information is, ooh, volume pressure. Well, however you want to measure the information within the market, it doesn't matter. It's the amalgamation of a bunch of things that you can't see and don't have access to. And this is all wrapped up in perspective. You might like some of my other videos on perspective because that's where it comes from. You're looking at the market from the outside. You're making a bunch of idealistic assumptions because you're not in the market. You're not participating. You're just kind of looking at it. And then you're going, aha, it must work like this. It's all idealistic. It ignores all the details. It ignores all the things that would say this is wrong or this is dumb or this doesn't work because you're assuming this perfection. And sure, we have to assume perfections and ideals, but maybe when we let everybody do that, mostly what happens is they get it wrong because most people get most things wrong. And it's very hard to understand something from the outside without making it too flat to really get it a sense for the details. Now, the problem is there are some people who can do this and they do it really well, but the odds that that's you are like 0 or close enough to it that it doesn't matter. And the odds that your favorite person who's popular because efficient market hypothesis has been around forever, or people who are smart are listening to this are pretty high, even though it's wrong. And so you have to be really, really, really careful. This is why I like to ask people, where are you getting that from? What did you base this on? What evidence do you have to support your theory? And usually they will fall back on an authority. They'll make an appeal to authority, and fair enough, we all have to appeal to authority at some point. But if you appeal to the authority of, well, efficient market hypothesis states, then I know you're wrong. I know you're wrong. You can't derive anything correct from efficient market hypothesis. Now, you can derive incorrect things and be right despite your incorrectness, but that's not impressive. People do that all the time, and I'm not interested. I really do want something where your derivation has some staying power over time because it matches with reality. So hopefully this sort of helps you to see just a handful of ways in which we fall into this trap. There's lots of other things like this. I'm going to, at some point, try to come up with a list. I always hear them in the moment, and I'm never in a position to write them down and say, oh yeah, this is one of those things that is obviously wrong that everybody, sort of parrots or mimics because they mimic it. So look, I hope you guys found this helpful, and I hope you'll think more about maybe even your ability to be critical, because it's not easy being correctly critical, right? It's not easy observing things. Like, who wants to go to Africa and watch them slaughter each other in certain countries? It's just going on all the time. In my entire lifetime, I don't think there's ever not been a war in Africa. Nobody ever talks about that because they treat Africa like a country instead of a continent, right? But like, you can't make assumptions about what that's like. Was it really a genocide, right? Was it really one side slaughtering the other, or was it, hey, my neighbor pissed me off, and even though he's of the same tribe, I'm going to get rid of him and blame the other guys, because could be. This is all these details that break down these idyllic visions. Sometimes that's not important, but more often it is very important. So being critical is hard, especially if you've never been participating in the thing. And observing things correctly is hard all by itself. And knowing which experts to pick is impossible. That's why you shouldn't trust experts. You should trust leaders. Leaders are willing to take on the responsibility of their correct or incorrect decisions. And they're the ones that get to decide, this expert sounds kind of good. This expert sounds kind of bad. And sometimes they get it wrong, because you would get it wrong too sometimes. And so you have to have a little bit of understanding for how difficult this is, not just for you, but for everybody. And because this is difficult, and talking about this is difficult, I do really appreciate, because I know it's also difficult listening, your time and attention.